Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, two 20-year-olds explain to you why you should or should not buy a house right now.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
Rob, 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us.
Pennies.
Going in Raw.
Featuring Dan, Deity of Dips,
And Hugh Henny.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is Wednesday, May the 25th, and the new housing report just came out. But before we go into that, we want to talk a little bit about the market as usual. Still on the same little bit. I mean, we can keep guessing where it's going to be, but it's probably going to be like fucking 386 when the weekends, if not 380, or it could be 405, and who fucking knows? We haven't been right on that.
Or 450.
Yeah, or 450, dude. There is no telling. The only really big movie we really saw today, Snapchat dropped 40%. And that wasn't on an earnings or anything, was it?
No. Well, yeah, they did. So Snapchat dropped at the end of the day down 43% at $12.79. And I mean, wow, what a debacle. This thing was at $80. I mean, that's just insane. Hang on. Let me find this real quick. Okay, so the CEO was at a conference, and Evan Spiegel, the CEO, says Snap will miss its own targets for revenue and adjusted earnings in the current quarter. And then the social media company will also slow hiring the end of the year as it looks to manage expenses. And so basically, Evan went on to say the macro environment has deteriorated further and faster than we anticipated when we issued our quarterly guidance last month. Not fucking 6 months ago, not 8 months ago, last month. So this is one of those things where, we always talk about companies. And the one thing that we always talk about is, they'll scream from the top of the hill when there's a potential, good catalyst that they're doing. But when there's a bad catalyst, they'll wait till the absolute fucking last minute and then give it to us.
It's like the government with inflation and everything. Like, everything's fine.
Literally.
And then right when it's like everything's about to fall, like, maybe everything's not fine.
Yeah, like think about it. Like, how long have we been hearing about Snapchat sunglasses or whatever, like the goggles? Like we heard about that 5 years even before.
And I've got fucking Ray-Bans with sunglasses on them already, and they don't do Snapchat.
Yeah, and now it's like now we're hearing about they're waiting till the very last minute to tell us that they're going to miss. However, I will say, though, that to see Snapchat down 43%, I mean, this literally goes back to what we talked about. It's literally like they're just taking all of these tech companies out to the back of the woodshed. But guess who sold at 80? Mr. Spiegel, Evan Spiegel, the CEO, was selling stock in the 80s.
I mean,
wild.
It's not a fair game we play. So I guess, do you want to now just go ahead and just dive right into the housing market? I mean, we've got a bunch of numbers. We've got a lot of numbers to go through. And even before today, just so we can give you guys an update on like what it was before and what it is now, the median home price was up, I think, I actually edited this on some of the newer ones, but the edited median home price was around 27% since start of pandemic, now 34%. And these are like numbers from around 6 months or 3 months ago. Up 20% in the last 12 months, from 329 to 428K, from 3.2 to 5.4 interest, highest since 2009. The home affordability rate, due to the cost of housing market and interest rate, is at its worst since July 2006, when the average interest was 6.7%. And go ahead.
I was just gonna cut you off real quick before continuing, just to put it in perspective in kind of like layman's terms. Basically,
I had some layman's terms before you.
Go ahead. Sorry.
But here, let's see how my layman's terms do, and then you can see yours.
Yeah.
In 02, so you have to think about the changes of interest in 2002 and 2006. The average amount of a family's income on housing, the difference was only 2%. Was 32% in 02 and 34% in 06.
Yeah.
That's the big thing, because usually when inflation's going up, the price of the house goes down, making it still around the same affordable amount. That's basically what the home affordability rate is. So where are your layman's terms?
No, but pretty much what I was just going to say is that the difference here that like we're really seeing is that typically what you'll have is that you'll have interest rates rise, which bring down the cost of homes. And typically, it is a slow process. It's not like we raise interest rates and a month later or even 3 months later, housing is down 30%. That's not typically the way that works, but you do see a pretty significant decline. But the issue that we're facing, though, is that we're raising interest rates for the obvious reasons. But because housing fucking doubled in the past year, it doesn't matter if housing comes down 30% this month alone, because we're still up. Homes that were going for 400,000, maybe they were going for $1 million, 3 months ago. Now they're going for like 850. So even though it's a decline, the issue is that housing is still so expensive comparatively.
Yeah, and the reason is like if you look at more numbers, before the pandemic, the average amount of houses was around on the market was around 1 to 1.5 million. Now it's only 500,000. So supply and demand is still, holy fuck, we need houses. If everyone needs houses, price is going to go up. Well, everyone needs houses and interest is going up. We're kind of putting ourselves into a really shitty situation. And then on top of, inflation, it's like, where do you go? And we all get mad at the government for all this, but it's not a envious position to be in.
No. And so that's why it's really tough right now, because here's the other tough thing. Okay. Is that it kind of feels like similar to like retail gets screwed on both sides. It feels like with the housing market, it feels like typically, like the family home or like the family homeowner kind of gets screwed no matter what, because you raise interest, when interest rates are low, housing is typically pretty expensive. So it's like, a house that was going for 500,000 now is going for 700,000. So you can't buy the 700,000 home that you wanted because now it's 900,000. You know what I'm saying? But interest rates are low. However, then when housing comes down, consequently, typically rates are up. So now you got to choose, okay, how do you go for the house that, like let's just say the house that you're paying up for to get the lower interest rate? Or on the flip side, do you go for the cheaper house, but then your interest rate can be like 15%? Like I was talking to my aunt the other day, her interest rate in the 80s was almost 20% on her home. That's fucking wild.
Yeah, it's
so
like
it kind of
it's like
feels
going
like
one of those like stores on the side of the road. It's like get $5,000 today, you know?
Yeah. So it kind of feels like, it's kind of like a lose-lose. Like you just got to pick your poison because no matter what, you're either going to get a home undervalue, but your interest rate's going to be ridiculous, or you're going to overpay, but your interest rate's going to be low. So it kind of sucks in that perspective. And I understand that like that's the way that life works. However, it just kind of sucks because on the flip side, like it kind of feels like, people with tons of money who, are like real estate investors, let's call them, or let's even take like BlackRock, they clean up when interest rates are low because, they'll be selling assets because again, they're at inflated prices. And then when interest rates, go through the roof and home prices go through the floor, they're sitting there with all cash offers, buying it for a 30% discount. So, and I understand like that's kind of how the world works. It's just like, sometimes it's kind of like, damn, this sucks.
Yeah. Well, I mean, if you want to just get into some more numbers we have, do you kind of want to get into some of the like newer ones? Because I mean, even if you're just going on like 2022 random week to a random week in 2021, listings are up 8% this week from last year. So we're not really seeing a sharp drop in housing price yet because the supply is still fucking lower than the demand. And price drops are still rare, but the fact that they're actually happening, they're saying that's a bad sign. So I think like the main issue is like with people being like, yo, do I buy one now? And they're just gonna keep going up. Do I wait? I mean, that is the question for it all. And I guess what did exactly this new housing report shine any light on?
Yeah, so the new housing report, which this is significant. So it said new home sales was negative, minus 16.6%, and the estimated was 1.7%. So as we just talked about, it's not something that although it is cause and effect, it's not immediate. So as we talked about, it's not like interest rates rise and like 2 months later, everything's in the gutter. The way that it works is that there's a typical delay. There's levels to these things. That's not, it's not really one of those things that it happens immediately. And that's a really good thing, by the way, that it doesn't happen immediately. I just want to throw that out there. It's a good thing because if it did happen immediately, that would cause panic in most times, you want this gradual decline because again, one of the things that a lot of people say is that the only true hedge to inflation is real estate. And so if it was one of those things where, we raise interest rates, and again, why do you typically raise interest rates? There's a few different reasons, but mostly it's to control the economy and when the economy is, too good or inflation gets too high. So, you don't necessarily want like an immediate cause and effect. Just throwing that out there on the side. But this is significant because this is the first time this is the first time since the new, I'll call it cycle, where the estimates have been this far off to the downside. And so that's significant because, the next report could be pretty shocking across the board. This is like one of those, let me say, I'll call this like this is a warning shot in the water, I'll say. And so now it's like, okay, how is the next report going to come out? Because the next report could be like completely terrible to the point to where it could be all the numbers down across the board, number of homes listed, the average home price, all of those could plummet like 10, 15%. Or this could just be like the first sign of a slower weakening. Now, if we remember, last thing to touch on regarding this is if we talk about 08 was a pretty immediate impact. I mean, 08 was pretty quick. And so that's why this next report will be important, because we'll find out, does it follow the trend of, a slower progressive cycle? Or is it going to follow the 08 where it's like, okay, we got the first warning shot, and then it was like all of a sudden, like, home prices were down 25% by the next report. So this is why this is like kind of interesting, because we're kind of in limbo. If I were going to compare it to anything, it would be like the March Fed meeting. When we were waiting to see if they were going to raise interest rates and by how much. That's kind of how I think about this. Like we knew that the Fed was going to raise interest rates. We just didn't know how much and when. Now we know, housing prices will eventually come down. How much and when, we don't know.
All right, cool. And so before we get into like what a lot of companies are doing, because another thing we want to talk about is with the housing market is recession. You have places like JP Morgan Chase setting aside $900 million for, all this bullshit, $300 million for Russian turmoil and $600 million for economic turmoil. So people are ready for what seems to be a recession. And Guggenheim Partners chief investment officer even said, we are facing a possibility of a dreadful summer stock market with a potential of the NASDAQ to drop 75% from its peak. So if its peak was around 500, and this, let's for equivalent of SPY, I mean, that's 125.
Yeah, that's, I'm just going to respectfully say that is, how do I say this respectful? That's I don't want to say stupid, but that's not an intelligent answer. And I'm not super intelligent. However, for SPY to go down that much, we would be like
there would have to be 500 million Chinese soldiers on American soil.
Yeah, quite with like, honestly though, like that's literally like our at that point, if we got to that point, our least concern is the fucking market. If we had an actual true catalyst that brought SPY down to 125, our smallest concern, I mean, something like along the lines of China, as Dan said, would like have to invade us because, they recalled all their debt, like the trillions of dollars that we owe, something along those lines. Like so much shit would have to happen. Like that didn't even happen. Like we had a pandemic that people were comparing to the bubonic plague. The bubonic plague. And SPY still only hit 218. It went from 340 to 218 on like those concerns. So for us to go from 470 to 120, that's honestly that's like one of those things that like that it kind of feels like let me see. It kind of feels like when all these like analysts and not just the analysts, but like, the directors of the people that are supposed to know finance, like, like this guy, like who's it, the Guggenheim CEO? Yeah, CIO. It's kind of like one of those things where like, you kind of missed the ball, you kind of missed the ball. So now, because you kind of missed the ball, you got to be overly dramatic. You know what I mean? Like it's one of those situations where, let's just say like,
it's like sports take analysts being like, Luka's the best player we have ever seen.
Yeah, we've ever, it's not even close, or like one of the things that I think about is like, is that, is like, if you're like a avid cheater on your girlfriend or something, and an
avid cheater.
What is a frequent cheater?
Okay,
a frequent cheater on your girlfriend, and she walks in and she's like, "You cheat on me," and you're like, "No, you cheated on me." Like you double down and like hit reverse.
Yeah, that's fire. I like that. That's a good call.
You know what I mean? So I think it's one of those where it's like, where it's like, like maybe like Guggenheim and everybody else, like I'm saying everybody, might have missed the boat. And now that we're like teetering on in a recession, now it's like, they got to double down and be like, oh, shit's going, to the wayside. So I think like that's pretty important. And then just like to touch on, because I just want to reiterate this. A recession is a natural market cycle. Okay, like, do we want a recession? No. However, it's a market cycle, and it is overall, it's kind of like a dip in the stock. But I guess it's like pretty fair. It's kind of like a dip in the stock.
Dick in the sauce.
Do we want a recession? No. However, it's a natural progression inside the market cycle. And unfortunately, we have seen quite a market cycle. We've seen quite a market cycle. Yeah, inside the past 15 years. And so it's one of those things where like we're honestly overdue. What we've seen inside the past 15 years, even before COVID was an anomaly. So with COVID, it's wild. That's the only thing that like I kind of want to touch on that. Like, do we want a recession? No. However, it is a natural progression inside the market cycle.
Have some money on the side for it if it happens.
Yeah. And the last thing is that, like, listen, don't worry. Like, you listen, like your 401ks at this point. Honestly, if I'm being completely honest, if you have individual stocks in there outside of Microsoft, Amazon, and like Google, you're
I'd be scared about Amazon.
Yeah, like you're probably getting pretty close to smoked. So in that regard, just listen, invest in target date funds, invest in index funds, and just sit back. Like realistically, you should want the market to see, when I'm talking about the S&P 500, 3,000. Because anytime that it goes below the let's call it the 200-day weekly average, which right now it's sitting at 360. Anytime it goes below there, it's usually a generational buying opportunity. If I go back to I'm looking on TD. If I go back to the max the max chart, and I go back to the weekly, every single time it bounces. I don't even know when this was. This was 2016, bounced off of it. 2018 bounced off of it. COVID, it did go below it, and we saw what that did. Another thing, the last time they went underneath, 2008. Again, guess what SPY was at? $64. Like, these are all, like, you could have basically 8x your money. The time that it did that before was the .com bubble. Like, all of these, anytime that it dips below, 3 times inside the past, the past like 30 years, it's dipped below the 200-day weekly moving average. And every single time, it's been a generational buying opportunity. Like I said, SPY, 217 was its bottom. It doubled from then. And even with this massive pullback, you'd still be up over 50% if you had bought there. 2008, 2009, it hit a low of 62. Come on, it's buying opportunity. Again, now 2002, it did hit again that low of 62. But again, if you had just kept accumulating underneath that 200-day weekly average, from the .com bubble, if you had bought in 2008, it went all the way up to 160. So if you basically just, like, your only strategy could be buy underneath the 200-day weekly average and sell at 100% gains, guess what? .com bubble, you would have sold in 2007. So you would have doubled your money in like 5 years. Let me see, 08. You would have, if you had gotten in, like, let's just say 70, you would have doubled your money by like 4 years later, and so again, you would have sold, and then again, you would have bought again during COVID. And let's just say, like, COVID hit at like a bottom of like 215, but let's just say you bought like 240. Or what I say, bottom was like 215. So like, let's just say you bought like 220. Like, you still would have doubled your money, even though you're buying even though the market's still $200, like, you still would have doubled your money and sold. So it's one of those things where, like, listen, you could keep this kind of strategy where, like, you only buy underneath the 200-day weekly average and sell it. Let's even be conservative. Let's say you sell a 50% gain. Like, all of these are generational buying opportunities. So if we do get below that SPX, like, let's call it 360, but let's put a round number on it. Let's just say that we get below like 350 and we're heading towards that 300. Like those are generational buying opportunities there. So we don't want a recession. Like we don't want to see SPY 250. However, those are you should be like kind of hoping that there's a chance to buy there. Like we don't want to see it hang out there, but it's not like we're the worst thing in the world. So that's my point is that like me myself, I don't have tons of money inside long term. However, like 330 on SPY, like really fancy is big.
Yeah, no, I think I was thinking 330 as well is also a really good one. But like you said, we don't want to watch it just chill there, which is the really shitty part about what we've been seeing recently. Like with it just chilling there right now, and you're just in like the purgatory of what's going to happen. Like, are we going to heaven or hell? Are we going to 500 or 300?
But that's also where like it's okay because you can have the strategy. The strategy that I love is the 20-20-20-20 rule. Okay, let's just say that you have $50,000 on the side inside some retirement account, or just in general, you just have $50,000. Let's just say that at three. Let's just use the 200-day weekly moving average. At 262, you start at 262. Not at 262. At 362, you buy. Let's say you have 50 grand there. Let's just say you put $10,000 into SPY. Okay, and then at 330. What is that? 312 is nope. 300 is, let's just use like a round number. So, you buy something at like 362 and then, down another 17% is at 300, then you put in another 10,000. So now you have 20,000 in there, and then if it goes from 300 to 250, that's another 16%. So realistically, this time, you'll wait till 235. That's 21%. And then you put another 10,000 in. So now hell, SPY's at 235. It's down 50% from all-time highs. And you still have cash on the sideline. Your average will be, let's even say like 295, something like that. Guess what? SPY just gets back to all-time highs. You're going to be sitting pretty. But let's just say that SPY goes down another 20% and goes from 235 to this Guggenheim CIO's like thing, and you buy at like 185. That's another 21%. That would be like one of your last scaling spots. So now you have 40,000 of the 50,000 in, and SPY's down like 70% or something crazy. No, what would that be? Like 60%. SPY's down like 60%. You still have some cash on the sideline. Your average is going to be like 240 instead of where you first bought at 360, and you're sitting pretty no matter what, because again, the market always hits all-time highs. So I love that strategy. Again, the chances that if you start scaling in below that 200-day weekly, the chances that you even get to buy 3 times using that strategy would be like a 13 sigma anomaly. But who knows? Maybe we get that opportunity. But that's why you have this plan. It's a win-win. SPY goes down to 185. Guess what? You get to have like most of your money in at a super low average inside the low 250s, let's call it, but if SPY decides to go back to all-time highs, guess what? You still have exposure. It's literally a win-win situation. And that's how you should think about this market for the future and for the long term.
So what's SPY going to do? No, I'm just playing. But yeah, no, a lot of the numbers they give sometimes are just so out of whack. It's like, where do they even come up with them? And then again, we just have the same ones, just slightly smaller. When you go into other signs of a incoming recession, you see one thing you're starting to see right now is like big companies, Target, Walmart, a bunch of them are warning their investors of an impending recession so they don't pull out. Everyone sees their 401ks drop, it scares them. That's the part that you really got to worry about. There was a poll of 138 publicly traded CEOs. 60% said that it would get worse, as opposed to 19% saying that the market would get better over the next year. Another thing, credit card debt is up 25. American credit card debt is up 25% this year. Late payments are increasing way faster than usual, and 2 consecutive quarters of declining GDP is the most agreed upon definition of a recession. Quarter 1 was negative, and we're about to find out if quarter 2 is as well.
Okay. So listen, and I don't want to like necessarily throw too much shade at like CEOs, but again, it comes back to what we just talked about, like the Guggenheim CIO. The Walmart CEO, he's not going to say, hey guys, a pending recession when his stock price is at over $150 a share. But take this into account. This is just wild. If you had bought Walmart 2 years ago today, you would be down on your investment by, less than 1%. However, you'd still be down on your investment. And so the reason that, again, it's kind of one of those things where which by the way, if you look at this Walmart chart, it's freaking ugly. That weekly, in 1 week, it went from 150 to sub 120 and closed there.
Dude, as someone who grew up in Alabama, Walmart will never die. I can promise you.
So I don't think it's like one of those things where like they necessarily, I just don't think they know, but like that's who people are looking to, to calm their nerves. And so instead, they already kind of missed the buck. Like, honestly, I'll be honest, typically for me, my gauge of sentiment is like when people start asking on Facebook, hey, should I be like selling my 401k? That's probably when I'll start buying SPY. So I know that we just talked about like that 360 area. If people start posting like, hey, like, oh my God, the recession, or like CNBC starts like, crying wolf, which they did just start, that's going to be one of those things where like, I'm probably going to be looking to like add to my long-term portfolio, because again, it's the same thing like when the kid that shoe shines your shoes.
How about just shines your shoes?
Yeah, okay. Yeah, when the kid shines your shoes when the kid that shines your shoes is giving you stock advice, that's the time to get out of the market. It's the same thing like when everybody's screaming from the top of their lungs, recession, that's probably when it's time to start looking long again. And so again, is that a recession is literally just part of the market cycle, like it's not good because the average family gets hurt, like you don't want a recession. However, it is part of the natural market cycle. And so when people are starting to scream like, like the world's ending, there's different levels to a recession. And honestly, if I'm being honest, we I don't know how this one plays out, but the other thing to think about is that student loan payments have been held off for the last 2 years. That's like, I don't know what the average person pays in student loans. Maybe you guys could tell me like, what an average person pays, or like, just give me like an insight, but like, $300 to $500, let's just say someone's paying $500. They haven't had to pay that for an entire 2 years. When you have to start paying that and it hasn't been inside the budget for 2 years, I think that's going to be a real wake up call for a lot of people, because again, let's just say that your average, the average person makes like 70 grand. But let's just say that their average take home is like, it's like $1,500 a week. If their take home is $1,500 a week, and for the past 2 years, you haven't had to pay $500, that's almost 10% of what they take home every month. So I just think that that's like something like 10% is a lot every single month. And so I think like that's another potential catalyst. That's all.
All right. Well, do you have anything else you'd like to talk about on our Fear All BL episode of Pennies Going in Raw? Letting people know they're all screwed. Recession's coming. And houses are fucked. We'll all be homeless. And I'll see you guys under the I-85 bridge. Is that all you got?
That's all I got.
All right, guys. Well, we hope no one was scared too much. We hope everyone has a great rest of your week, and we will see you all on Sunday. Peace.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.